Welcome to the Deep Dive. Today, we're getting into something really fundamental for Europe. How do we boost our competitiveness, get more innovation happening, fuel some real growth, and, ultimately make people feel more optimistic and happier?
It's a huge question, and it goes way beyond just economics, doesn't it? It's really about our collective future.
Absolutely. And we're basing our chat today on a recent policy brief. It's called Keeping Up with the U.S. Why Europe's Productivity is Falling Behind.
Yeah, it's a really interesting piece. It highlights a trend that honestly has been a bit worrying for a while now.
It really has. The brief points out that for decades, actually, the EU's productivity growth just hasn't kept up with the U.S.
Yeah.
Sure, maybe recent events have made the gap wider.
But the roots go much deeper. And this gap, it affects our living standards, our economic clout on the world stage, everything really.
Right. So our mission, if you like, for this deep dive is to unpack the four big reasons the brief identifies for this productivity divide.
And then, crucially, talk about what can actually be done. What actions could the EU take? What about individual member countries, European businesses?
And importantly, what does it mean for everyone listening? We want to pull out the key takeaways so people understand what's going on and what the options are.
Exactly. Let's get into it.
Okay, so the brief starts by setting the scene, looking at the long-term picture. And it's not exactly a rosy picture, is it? This isn't new.
No, not at all. For a long time now, real economic growth, GDP per person,
Yeah.
especially in Western and Southern Europe, it's been pretty sluggish.
Sluggish is maybe putting it mildly. The brief has this stark comparison.
Oh, yeah, the U.S. state comparison. It's
Yeah.
as if the EU were a U.S. state, it'd be the third poorest.
The third poorest. Wow.
Yeah.
That really puts it in perspective, doesn't it?
It does. It frames the scale of the economic difference we're talking about.
So when we talk about productivity, what are we actually measuring? It's not just working harder, is it?
No, absolutely not. It's about the value we generate from our work, from our resources. Labor productivity, that's GDP per hour worked, is a key measure.
And how do we stack up there?
Well, back in 1990, the EU and US were pretty much neck and neck on that measure. But since then,
The U.S. has pulled ahead.
significantly ahead, yes. The growth rate of labor productivity in the euro area has been much, much lower than in the US.
Okay, so what's driving that difference? Is there a specific factor? The brief mentions TFP, total factor productivity. Sounds a bit technical.
It is a bit technical, but it's super important. TFP tries to capture how efficiently we use both labor and capital, like machinery, tech, buildings. Think of it as, well, the secret sauce.
A secret sauce. Like how good we are at combining things to get results.
Exactly. It reflects technological progress, innovation, better ways of organizing work. Now, interestingly, TFP growth has actually slowed down everywhere since the 60s, both EU and US.
Okay, so it's a global trend.
To an extent, yes. But the EU's slowdown was much sharper, especially after the 2008 financial crisis. That suggests there might be some deeper, more structural issues holding Europe back.
Right, that makes sense. So a long-term gap, and TFP points to maybe some underlying efficiency problems here.
Okay.
Let's dig into these four engines of divergence the brief talks about. First up, the innovation process, R&D spending, and patents.
Yeah, this is fundamental. R&D is basically the investment in future ideas and technologies. And the brief points out that even back in 1991, the U.S. was already outspending the EU significantly on R&D.
And that gap hasn't closed.
Quite the opposite. It's widened a lot. Between 2014 and 2021, the U.S. average annual growth in R&D spending was literally double the EU's rate.
Double. Wow, that's huge. What about the people doing the research, the scientists, the engineers?
That's an interesting point. The EU actually ramped up the number of researchers per capita and sort of caught up with the U.S. in sheer numbers for a while.
Oh, okay, so that's good news.
Well, yes and no. Because after 2015, the U.S. rate accelerated again, so they started pulling ahead once more in terms of the research workforce intensity.
And the output, the actual inventions, the patents.
This is where it gets quite concerning, according to the brief. The number of EU technology patents has basically been flat since about 2006, just stagnated.
Well, the U.S.
The U.S. has seen continued growth, and maybe more importantly, if you look at the really cutting-edge, complex technologies, think computer tech, digital communications, semiconductors.
The stuff that's going to shape the future.
Exactly. The U.S. now files way more patent applications in those areas, and that gap is widening too. It suggests a potential loss of leadership in key future industries.
Okay, that's a clear, if worrying, picture on innovation. Engine number two is the power of intangible capital. Sounds a bit burial.
It does, but it's incredibly concrete in its impact. Intangible capital is all the non-physical stuff that drives value. Software, databases, R&D itself, branding, industrial design, even employee training and skills.
So the know-how, the digital assets, the smarts.
Precisely. And it's crucial for actually using new technologies effectively across the economy, which is what really boosts overall productivity, or TFP. It's not just having the invention, it's putting it to work everywhere.
Got it. So how are we doing on investing in this intangible stuff?
Well, both the US and the Euro area now actually invest more in intangibles than in traditional tangible things like buildings and machines.
Yeah.
That shift has happened.
Right.
But the US started that shift earlier, and crucially, they invest a larger share of their economy in intangible capital compared to the Euro area. There's an investment gap there, too.
And does that link to our digital infrastructure?
Absolutely. The brief highlights that the U.S. invests significantly more in ICT, information and communication technology-related capital across all sectors, but especially in services.
And Europe lags behind there.
Yes, and that lack of sort of underlying digital muscle makes it harder to get the full benefits from digital tech now, and it potentially limits future growth from things like AI. The projected AI investment figures for this year show the U.S. spending vastly more than Europe.
Which then logically means the ICT sector itself adds less value to the economy here.
Exactly. It contributes far less to overall value-added growth in the Euro area compared to the U.S. So investing in knowledge, data, software, it's critical.
Okay, engine 3, market dynamism. This is about how resources move around.
Yeah, it's about how efficiently capital, investment, and workers flow to the most productive and innovative companies. Competition is key here. If markets are sluggish or clogged up, that flow slows down.
The brief mentions business churn. That sounds disruptive.
It can be, but it's actually seen as healthy. It's the rate new firms pop up and older, less efficient ones close down. Economists call it creative destruction.
Like clearing out the old to make way for the new?
Kind of, yeah. It frees up resources for more productive uses. Now, this churn rate has slowed everywhere since the financial crisis,
Okay.
but it's still higher in the U.S., mostly because they have higher exit rates, firms closing down. It suggests maybe a bit more willingness to let less productive ventures go.
Interesting. And what about our ability, Europe's ability, to actually get investment and talent to the winning firms?
That seems to have stalled a bit after the crisis, too, according to the brief. Europe's allocative efficiency, its ability to shift resources, didn't improve much. And job dynamism, the creation and destruction of jobs as companies adapt, also declined.
So less fluidity in the market.
Potentially, yeah. Less movement of resources towards the most promising areas.
And what about startups? They're meant to be engines of dynamism, right?
Absolutely crucial. They create jobs, drive innovation. Now, the share of startups is often higher in some EU countries, which sounds good.
But there's a catch.
Well, the trend in some key EU economies has been downwards. And perhaps more tellingly, U.S. young firms, especially in innovative sectors, seem to get a higher return on their R&D investment than European ones.
Meaning they get more bang for their buck from their innovation spending.
That's what the research suggests, yeah. It hints the U.S. ecosystem might be better at helping those innovative startups scale up and succeed.
Okay. Lots to think about there. Final engine? Embracing the world trade and investment. Now, Europe's pretty open to trade, isn't it?
Oh, definitely. The EU's openness trade as a percentage of GDP has shot up over the years and is much higher than in the U.S. We trade a lot with the world.
And we're involved in global value chains.
Yeah, the EU participates more in those complex GVCs than the U.S., and generally, more trade and GVC participation should boost productivity through competition and specialization.
What? I sense another but coming.
Well, the but is around foreign direct investment, FDI. This is where the story flips, according to the brief.
How so?
The U.S. is now attracting more inward FDI investment coming to the U.S. than the EU is, and it's also generating more outward FDI U.S. companies investing abroad.
So money flowing both ways seems stronger for the U.S. What does that imply for Europe?
It suggests the EU might be becoming relatively less attractive as a place to invest. That's concerning because FDI often brings new technologies, expertise, and access to global markets. It could signal lower confidence in our growth prospects compared to the U.S.
Right. So open for goods, but maybe less attractive for capital investment recently.
Okay, we've covered the four engines. Innovation, intangibles, dynamism, and global links. Now, the big question. What can we actually do about it? The brief gives recommendations for different groups. Let's start at the top. The European Union itself.
Okay, for the EU level, the brief has some pretty clear messages. First, R&D spending needs a serious boost, that old 3% of GDP target. The brief basically says it's not enough anymore.
Not ambitious enough.
Not if we want to catch up. The recommendation is to aim much higher, like 4 or even 5% of GDP by 2040. That means, realistically, doubling R&D spending in the next big EU budget cycle.
Doubling. Okay, that's a big commitment. What else for the EU?
Second, really prioritize investment in those intangible software, data, skills, and the digital infrastructure needed to support them. This means tackling barriers, especially in the single market for services, because that's where a lot of intangible value is created and traded.
So making it easier to trade services and digital goods across borders. Exactly. And fostering an environment where private companies want to invest in the networks and infrastructure needed for things like AI and advanced connectivity.
And the third big one for the EU was about the single market itself.
Right. Yes. Revitalizing it. Making it the most competitive, most dynamic market in the world. Policies should really encourage entrepreneurship, make it easier for firms to start, grow, and yes, sometimes exit if they aren't competitive.
Getting those market dynamics working better.
Right. The goal should be, as the brief puts it, creating conditions so that if a company can succeed in the EU single market, it's ready to succeed anywhere. A real proving ground.
That's a strong ambition. Okay, what about the individual member countries within the EU?
They have a huge role, too. They need to take more ownership, basically. Implement policies at the national level that really encourage their own private sectors to invest more in R&D.
So tax breaks, incentives, things like that.
Could be, yeah. And also expanding their own national research budgets. Innovation isn't just decided in Brussels. A lot happens locally and nationally.
Makes sense. And what about businesses, the companies actually operating in Europe?
For businesses, the message is clear. Recognize how vital investing in intangible assets and digital transformation really is for your own productivity and competitiveness. Don't wait.
Be proactive.
Exactly. And also really leverage the opportunities the single market already offers. Use it to scale up, reach more customers, become more efficient. Don't just think locally or nationally.
So embrace the scale Europe offers. Okay, finally, what about citizens? What's our role in all this?
Well, it's crucial that people understand why this matters. These aren't just abstract economic debates. They directly affect future jobs, wages, quality of life, public services.
So getting informed and engaged.
Yes. Engage in the discussion about why innovation matters, why research is important, why having a dynamic economy benefits everyone in the long run, and, support policies and leaders who are genuinely trying to build that more competitive, innovative Europe.
It really connects the dots from high-level policy to individual well-being.
It has to, ultimately.
Okay, so let's try and wrap this up. The picture is clear. Europe has a real productivity challenge compared to the U.S. It stems from lower R&D and intangible investment.
A less market dynamism, and a worrying recent slip in attracting FDI, even though we're very open to trade.
And we've explored what the EU, member states, businesses, and citizens might need to do to address this.
Yeah, we've unpacked those layers based on the brief's analysis and recommendations.
And that final thought from the brief is quite powerful, isn't it? That idea of setting market conditions so that if a company can make it in the EU single market, it can make it everywhere.
It really is. It frames the ambition perfectly. What does it take to create that kind of environment?
Exactly. What does that truly mean for innovation here? And what role do we all play in making that happen? Something to think about. As always, this deep dive is just the start of the conversation. Thanks for joining us.